Hello traders, Gary Wagner here, approximately 10:30 in Honolulu, 4:30 in New York on Wednesday, 2nd day of October 2013, and this is the daily report for gold and silver. After witnessing drastically lower pricing yesterday, and you can see that here, 1335 comes down. We've got a low that touches just below 1280. We're getting the opposite today. In other words, after trading sideways, we got that upside bounce. Market is currently trading up about $30 on the day. 1316.54 current print with a high of 1325.10 and a low of 1285.30. Very similar activity in silver. Silver trading up 2.81% higher, up about 60 cents. You can see it's coming off the highs here. 60-minute chart, 21.73. That's our current price. We had a low today of 20.94 and a high of 22.14. Now, of course, once we compress this chart to show us a little bit more data, we get a different picture. And the picture that I'm getting is when we look at these series of tops in here, we are still getting this descending high. In other words, we're getting a series of lower highs if we look at this last set of highs as the market came up. And when we look at the lows, we are still getting a series of lower lows, indicative of a market that's moving down. However, there are a couple indications that we might be forming a base or some sort of potential bottom. We are going to talk about that on today's show, but this has not been an easy market to call. When you get the sizable moves that we've gotten to the upside and they're followed directly the next day by sizable moves to the downside. We got that yesterday with the sizable move to the downside and then a follow-through sizable move to the upside. When we do that, what we really want to do is compress the chart, kind of stand back to get a more clear picture, if that is at all possible, of what we are currently seeing in this market. Now, the key is that we have hit a Fibonacci retracement area that we were looking for in the market. Really, 1276 was a number. We're just a little bit above that. That's at 61% retracement. We'll talk about that in a second when we pull the chart up. 180-minute chart here, and it becomes even more apparent just the kind of crazy oscillation that we have seen in this market as it rises and then falls the next day. We're getting that same activity again. Now, we are seeing some weakness come into the market. It is $30 higher on the day. You've got this red candle now forming. And the fact is that when we look at where these highs have come in, even with these tremendous spikes, we are getting a series of highs that consistently have lower highs than the prior high. And that to me is indicative of a market that still absolutely is under pressure, even with the market up substantially today. Now, even when we look at this most recent activity, and I've pulled up a 440-minute chart to try to make a little bit more sense, and this is that area that we were looking at, and the fact that we have had a lower low than the previous low signals one thing. However, we really want to take a serious look at a level of support, and that level of support right now seems to be falling at approximately, call it 1280, 1285, roughly in that area. We've got highs that are above that. And when we take a look at a chart that has a couple of fib retracements in there, you can see where those numbers actually do make some sense and are logical points to look for potential bottoms in the market. And in terms of having a bullish bent to it or some sort of technical confirmation that we might have in fact seen a bottom, this is the most compelling piece of technical evidence I can come up with. 61% retracement, 1276. This is a short-term retracement. It is simply covering this last or most recent rally in which the market went from 1181 to about 1435, comes back down, goes just below that 50%, just below 1300, and pops up. You can see that it stalls right at the 23% retracement area, 1376, comes back down. As it comes back down, it does bounce off of these lows below 1300 We have bounced off of these lows here. We've also bounced off of these lows here. So in terms of straight Fibonacci analysis, we are looking at a scenario where we might in fact be looking at a bottom. The hard-pressed question is the way that this market has been oscillating with these extreme highs or extreme rallies followed by extreme sell-offs. And so we got that again the other day, an extreme sell-off. However, the difference is in this last sell-off is that we have some fundamental data that suggests that we could have found a tentative bottom in the market. And in fact, if we found a bottom, that bottom is roughly at $12.80 per ounce. Now, the one thing that I can say is the market has been reacting in a sort of finicky way to the recent events that we have seen unfold. In other words, when we looked at the stock market just prior to the potential shutdown of the United States for lack of funding, we saw the market go down. The following day, meaning the day of the shutdown, the market actually went up, believing that this would cause the government to maybe reassess our current debt ceiling and maybe take a stab at that. However, these recent stalemates and the inability for the government to do anything has kind of turned the pendulum the other way, in that we've seen heavy pressure in the stock market. There's been a consistent downtrend over the last few days in the equities markets, but gold has been all over the board. It's been up dramatically and down dramatically. The one key piece of technical evidence that I'm looking at, as we just said, is the fact that this last sell-off that we experienced yesterday did terminate on a technical basis at a fairly logical support level. And my sense is that if this support level holds, we might in fact be building a base and be looking for higher pricing in the gold and silver market in the days ahead. Now, we're looking at half-day Japanese average candlesticks. When we look at this area, 1280, and we just simply draw a line across it, we can see that that is a fairly critical area in which we have seen activity before. Supportive in these last two instances. Of course, as the market came down here, it fell far short of reaching this low, spiked back up to about 1380, and in fact this time has hit the low. We might have in fact washed out the series of shorts that have been entering the market and the underlying bearish pressure that we have seen in the market. However, the technical evidence, as I said, besides this support level, we are still looking at a market that has had these series of lower highs. And until we really break above any kind of these descending tops, once we actually break above that, or I should say if we do, it will be at this point that we can truly say that we've gone back into a rally mode. And up until that point, we're really kind of in nowhere land, in that we have these series of lower highs. We're starting to get what I'm going to call a flat bottom. And when we look at the daily chart, we actually broke out to the downside yesterday, but are right now back within that zone. Let me show you what I'm talking about. Now, when we look at our daily chart, this oscillation between dramatic highs, dramatic upside days, and dramatic downside days is really evident. You can absolutely see it on the daily candles when we look at this being that FOMC meeting. Following, the market comes down, trades sideways, tremendous spike down, market opens and actually trades to a new low right in here. This is our daily chart, cash market of gold. And when we look at this particular area, this is that 61% retracement area. It's absolutely a logical place to look for a potential bottom in the market, because we do have technical evidence. Now, in terms of a straight candlestick pattern, and as I said, when we have a market that gives us alternating views almost on a daily basis, we go back to basics, and basics to me are going to be certain candlestick patterns that we look for. This pattern that we're seeing today, this 2-day pattern, without a question of a doubt, is a very, very strong piercing line. Now, simply put, in a piercing line, what we're looking at is after a defined downtrend, and the market's really been in a defined downtrend, you get a long red candle, the market opens at or below. It's got to be at when we are looking at a cash market because it's a continuous contract, meaning they fix the price, it's moving for 24 hours. It's definitely closed above the midpoint. If we get the following in tomorrow or tonight's trading, meaning if we get a green candle with a higher high and a higher low, that candle itself right in here would be our confirming candle, and that candle would actually signal or trigger a buy signal on our daily charts. Now, if in fact that would happen, what kind of move could we expect to see in the market? Well, we have some real resistance. If the market continues to move up, we have real resistance in the market roughly at around 1370, and that has to do with this series of tops right in here. And I believe you can also see this is just prior to the market breaking up to these new highs, so we do have some technical evidence that this is an important number here, as it was an area of resistance before breaking through. You can't really say that about this particular area because it goes dramatically into it with the bodies, whereas here we're just seeing the tails of the wicks going into it. But I can tell you this, if we do get confirmation tomorrow and or today's trading session where we start to form this type of candle, we certainly will look to enter the market. We will look to see this market move back up, and we will also look for a move that could take us as high as about 1370 before running into any kind of real resistance in the marketplace. Now, traders, just as in gold, we're getting very, very similar numbers in silver. Silver is a lot more of a illiquid market, meaning it has less volume and is thinner and therefore is susceptible to more volatile swings. But when we take a look at the move from $18 up to $25 and the low that it reached in yesterday's trading, because previous to that we had these lows just below the 50%, but we did get the low come in close to the 61%, 2078. We have an engulfing bullish in terms of our 2-day pattern on our candlesticks. This is a daily chart, and we have in effect seen this market kind of fill this gap right in here in terms of price point, just coming about right to it. And so effectively we could have filled that little bit of a gap. But most importantly, what I'm looking at in silver, of course, is this engulfing bullish. If on tomorrow's trading we get a green candle with a higher high and a higher low, looks something like this, that would be our confirming candle, and that would trigger a buy in silver also. Stops are going to have to be fairly loose in this marketplace and account for the kinds of volatile swings. And so therefore, as always, we've got to be careful, but during this time, our due diligence and our belief that this market can pretty much do anything always has to be in the back of our head. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Thursday for another daily update review. Bye-bye.